in the space, and probably would bring in a lot of international experience also with her now. I believe the growth rate in this segment, which is a high margin segment, was very tepid, around 1%. And if it goes to 4 to 5%, I think HUL would see significant re-rating. As Mangala was pointing out, last 5 years stock has not done anything, thanks to earlier there was a lot of demand issues, first pertaining to rural, then urban stagnation. Now we would see that the P for HUL, which was trading at 7 to 8 years low, around 2200 levels, though there has been a sharp rise in stock price, but we still feel that if the demand revives, combination of premium products coming up, margins expanding, so I believe this would lead to re-rating of HUL, and combined with overall market where in large caps or even in mid caps where valuations is difficult to it's very difficult to justify buying a stock based on valuation. I think HUL would be a compelling story going ahead.
Okay, so positive view on HUL. Got that. Siddharth, good to have you on the show, connecting after a bit of a gap. So good to see you in. Overall, let's talk about earnings and what your estimates are for Q1. I mean, broadly, the expectation is that earnings will be much better this year compared to last year. Which would be the specific smaller segments or sectors where you would expect a meaningful growth pickup?
So, Subi, thank you once again. And great to connect back with CNBC-TV18. We are expecting H1 of FY26 to be a bit muted. And I think different industries also expecting the same. The growth would probably emerge in H2. And FMCG is one of the space where we would see growth would come back. We have some names like Godrej Consumers, then probably Bikaji over there. Then we would probably also see highly competitive space of late, Varun Beverage, which is also a part of our coverage. There we would see that earnings would revive. Stocks has been under pressure. Even if you look at some of the beaten down names, and I might be in minority over here when I state that we are expecting paint companies to see a higher growth rate. But again, I'm saying that it will be more of H2 rather than H1 over here. We are liking their Berger Paints, which is not the leader in space, but we are seeing, in fact, a few weeks back, management was there on your channel and they had a very positive commentary pertaining to the demand scenario. We also like Kansai Nerolac in that space, which is combination of industrial and decorative space. So these are a few names from consumer perspective. From BFSI, I think one should keep eye on what's happening in smaller banks. Some of these smaller banks who had exposure in MFI space have done a lot of rejig in their product mix. Also, there are some of the names down south where we are seeing the credit offtake in these banks are substantial. ROEs are improving. NPAs have been taken care of. And as everyone says that, corporate balance sheets have been a lot of pockets where probably you would see earnings reviving. But can you say that valuations are cheap? I think it's very difficult to say that. So a lot of tactical positioning one has to do in this kind of market. It won't be easy, just to buy and then forget it for 1-2 years. I think that it would be a lot of tactical shifting one would have to do if you are not a very long-term player in this market.
Got that. Let's quickly just address TCS because that's the big drag today. Stock is still down about 3.5%. And now the year-to-date correction stands at nearly 20%. Big miss on the company's top line, 3.3% lower. A majority of the reason is because of the BSNL ramp down. But even otherwise, ex of BSNL, the company degrew by nearly 0.5%. And the thing is that, when we asked the company, the management, about whether some of the projects which are paused right now, are there any signs of them restarting? He said not immediately. When also asked, then is Q2 going to be a washout? He said it's too early to say if it's going to be impacted, but he isn't seeing a big bounce back, at least coming through in Q2. Second half, we'll have to see how that plays out. So what should be the appropriate valuation multiple you should ascribe? Because, it's unlikely, given the state of affairs right now in the start to the year, clear that FY26 growth for TCS is going to be better than FY25 on the whole. For the ex of BSNL business, it may be. The management believes it can be. They're confident about it. But on the whole, they're saying it's going to be tough for the company's FY26 growth number to be better than FY25. So Siddharth, with revenue growth for India's largest IT company, what does this tell you about the sector per se and what it's likely to do in the next 1 to 2 years? And if someone is an investor, should they sell out now and perhaps look for other companies where there could be better growth, or this is not the right time to sell a marquee company like TCS?
Seema, we are negative on IT, and I'll tell you why. We are interacting with a lot of money managers, and beginning of this financial year, we took a call that if you want to beat, especially in a large cap fund, if you want to beat index, the strategy is simple, that you have to be overweight bank and you have to be underweight IT. These are the two heavyweights. Why underweight IT? Because now what TCS management said yesterday and today to all of you, that was clearly writing in the wall that because of geopolitical issues, because of trade conflicts, the most impacted sector for India would be IT, probably followed by pharma, because these are the two spaces where the exposure to US is pretty high. Growth. This is not first time IT space is experiencing that. We have seen this happening before, but what is different this time is valuation. Earlier, when we saw the IT space not growing or slightly degrowing, you would probably see TCS available at 20-21 times P. You would probably see Infosys available at 17-18, and HCL Tech Wipro probably less than 15 times. But right now, we are seeing most of these names are available at 25 times P. So I am not very comfortable, buying these names now. And if there is no growth rate, the only way they will become attractive in valuation by price correction. So even if you're an absolute investor, I think this is not time. This is not right time to take exposure in IT. And even in mid-cap space, where people would say the growth is coming in mid-cap space, and now valuations are happening in price to earnings, and people are adding PEG ratio in that. But the sensitivity to growth increases when you see PEG. So even if there is a slight fluctuation on growth on the lower side, you would see a significant derating in even mid-cap stocks. So I think for next 1 to 2 quarters, it won't be a wise thing to add too much of weightage in IT portfolio.
All right. Hi, Sid. Good afternoon. Good to see you in. Sid, give us one stock, though. IT, mid-cap IT could be a little expensive, but from the the mid-cap space itself, there'll be a couple of stocks that you like, right? Name one for us. Friday afternoon, our viewers would like to know one stock.
Just on other mid-cap space, yes, we are covering a lot of mid-cap names.
Give us one.
I mentioned one of these stocks. It's a Vikaji is something which we are liking in FMCG space. You can also look for Karur Vysya Bank from a mid-cap space.
Karur Vysya, got it.
Okay, so Siddharth, let's talk about some ideas. And as we go through some of these earnings, you've given us some names, BFSI, what you're watching out for, some of the paint companies. But if I were to ask you about 3 or 4 high conviction names from your list, your universe, and these are not short-term trades that we're talking about, but
that is Vikaji and Karur Vysya. These are purely based on fundamentals and the kind of valuations which you are seeing. So Federal Bank, if I have to elaborate on that, so this bank is showing decent credit offtake around 15% or so. We are also seeing that the exposure to MFI is negligible, and we are seeing improving ROAs. Also, we have seen that, from valuation perspective, it is right now available around 1.3, 1.4 price to adjusted book value. And looking at how, financials are doing, easily this stock can move towards, the valuation can move towards 1.6 to 1.7. So we have a decent price target of around, which is giving a decent upside of around 15 to 18% from 1 year perspective. Obviously, if markets are volatile, stocks can come down and you can buy that. Now, if I look at other spaces which we are liking, look at some of the names in cement space. Now, cement story is purely based on how much one is adding capacity. So some of the names which we recently added to our coverage, like Dalmia Bharat and JK Lakshmi Cement. Now, these stocks, of course, they have run up recently, and we did had coverage 1 month back. So these are also two names where we are seeing that the input cost pressure, be it the limestone, be it transportation cost, be it adding green energy to its consumption, we are seeing that from realization perspective, from pricing perspective, the environment is quite favorable for these names, and especially those companies which are trying to cater towards the eastern market, where demand scenario is pretty high. So even Dalmia Bharat and JK Lakshmi Cement are some of the names which we are liking from fundamental perspective, from long-term perspective.
Okay, all right. Thank you very much, Azad. Appreciate you joining us. I'm going to come back with Rahul Veera of Nippon India AIF on the other side. We'll talk some sectors and Rahul's broader market thoughts. Okay, welcome back. Now, about 35 minutes to go as far as market closing is concerned. I just want to quickly make a mention of what's happening in Religare. Religare or so at this point in time. Now, there is a board meeting today in which, most likely the Burman family, which already owns a little over 25% in Religare, is going to put in more money. Now, the widespread expectation is that they are essentially going to buy more than 5%. Remember, if they buy more than 5%, that sort of triggers an open offer. The offer will have to be, remember, there was an offer earlier. The earlier offers was at about 235 rupees, but that kind of failed because the price moved up and nobody really tendered their shares in. This time, of course, the expectation is that they will buy over 5, trigger the open offer, and kind of sort of acquire a substantial portion of the company. We'll see. We'll wait and watch what happens. Open offer, and trigger a pref issue. I mean, essentially the company does a pref issue, brings in some outside investors, etc. as well. So, as I said, the board meet is today. These are the two, in a way, sort of lines of thinking as far as Religare is concerned. We'll have to wait and watch to figure out what essentially exactly does take place with this one. But, you know, the story has been very clear, compelling in terms of Religare, the Burman family, you know, some of that Dabur P multiple magic rubs off on Religare, although in terms of the business value at Religare, it largely is the insurance subsidiary, which is Care Insurance. And of course, there was that protracted battle going on with the CMD, Ms. Saluja. So I think, you know, all of that, of course, also now fading into the background. The hope is that there will be the Burmans who will take charge and sort of build out the other businesses, broking, NBFCs and whatnot. So we'll see how this one goes. But you know, today is an important day in that sense, and a sharp up move coming through. Rahul Veera from Nippon India AIF is with us now to take us through what he's making of things. Rahul, good to have you with us here. Thanks very much. What are you eyeing, Rahul, at the AIF, at the fund? I mean, where are the opportunities?
We believe that overall at this point of time between the large caps versus mid caps, there is some valuation gap between the large cap and mid cap, but given the 1 year or 2 year, mid caps will relatively be better in terms of the absolute alpha or the outperformance versus the large caps. So across, whether it's banking sector or the IT sector, we've seen that the large caps in terms of their outcomes versus the expectations is relatively weaker. Whether it's bank or IT, you will see slightly better returns in the mid caps across banking or IT names.
So you want to just quickly, Rahul, tell us any big changes that you've made to your portfolio in the last 1 month? Any thoughts on IT and the way we've kickstarted the earnings season?
So in IT, we continue to remain a little bit on the mid-capish side. And we might take some contra calls on the ENRD space overall, which have not performed well. But we are seeing some slightly green shoots in that space. Probably some of the names that we have historically been ignored in the last 1.5 years could give some decent alpha over 1 to 3 years now.
So ER&D space, particularly auto, or it would be across, you know, tell us a little bit more
Across
about the thinking and what are the green
BPO
shoots that you're seeing?
We are seeing some commentary, positive commentary coming out on the lower base side. So some of these companies that have global companies, right, which have commented slight positive on the ER&D expenditure. So probably this will be the green shoot that we are looking at this point of time. The company's numbers that will be reporting on the domestic side will take some time to show that. But in terms of valuations, they are closer to the bottom now.
Okay, so that's a take on IT companies. Rahul, hi, good to have you on this afternoon. What's your stance on FMCG? Because the market is now building on this hope that maybe we're past the worst. And even if volumes pick up a little bit from here,